all to the financial management. So in today's lecture, let's understand the meaning and introduction of financial management and what we are going to study in financial management. So let's firstly understand the very meaning of financial management, what financial management is. So I'll be explaining financial management, the meaning of financial management by taking some brief examples. So let's talk about Tim. Now, Tim has got some money from his father. So Tim has got some money from his father. Now he's confused where to invest this money. So first option for him is that he can buy some asset out of it. He can buy some car, he can buy a bike, some shoes or branded clothes from it. Otherwise, he can also utilize that same sum of money to buy certain stocks or gold. So in second option, the Tim is choosing to buy some financial asset. These types of assets like stocks, shares, or the gold or land, these types of assets are regarded as financial assets. Why? Because these assets are employed or these assets are purchased by somebody to grow his money. It leads to growth in wealth of a person. So if the person invests in these financial assets, it can lead to growth in his wealth. Whereas if the Tim chooses the first option, he will just spend the money and it will not increase his wealth over the period of time. Whereas if he invests in another, there is a possibility that his wealth may increase over the period of time. So the choice that what a person makes to increase his wealth, that is what the financial management is. Financial management is choosing where to employ your wealth so that it can lead to some profits, it can lead to some increase in wealth. Every person wants to increase his wealth. So if I talk about any of the business organization, the basic objective of an organization, why an organization exists, is to increase the wealth over the period of time. So how this wealth can be increased by employing some of the money into the financial assets and ensuring that wherever the business is employing its money, it is generating good returns out of it. So this is the very objective of financial management. The objective is to ensure that the money is the limited amount of resources, the limited money of the business is utilized in such a way that it can increase the wealth over the period of time. So I've taken some Indian example. So I've taken examples of two business tycoons. So after the family property got divided, after Dhirubhai Ambani died, the family property was equally divided between Anil Ambani and the Mukesh Ambani. So what happened that if you see the progress over the period of time, the equal wealth, even though the money they got after the division of the property was same amount, but one person was able to employ his assets in such a manner that his wealth got increased over the period of time. Whereas if you can see the progress of another brother, you will see that he was not able to financially manage the resources, due to which he was declared as a bankrupt. So this is the very importance of financial management. Financial management ensures that your money gets employed in such a way that it can increase your wealth over the period of time. So, financial management can lead to a success of a business, or it can even lead to failure in the business. So, that is what the importance of financial management is. It can increase your wealth, it can improve the success of the business, or it can lead to the failure of a business organization. So that is why the financial management is very important for the business organization, whether it is a small business organization, medium scale business organization, or a large scale organization. Financial management is a blood, soul blood to run the organization. So what is financial management? Financial management is acquisition. It is acquiring some resources. So basic meaning of financial management is to acquire or to deploy some resources in an organization. Okay. So financial management is to ensure that the resources are acquired, few resources are required in a business organization, few resources are employed in a business organization, so as to ensure that overall objectives of an organization are achieved. So under financial management, what we are going to do is employ the limited wealth of an organization in resources in such a manner that it can generate wealth to an organization. So we will be employing our money, will be deploying our money in those projects which can generate further income, large sum of money from the given sum of money. So ultimate objective is the multiplication of wealth, increase in the wealth. So here what we are concerned with is like from where, from which sources this resources should be employed, and then which project should be incorporated, or project should be selected so that the maximum wealth can be generated. Coming on to the types of decisions which we need to take in financial management. So first type of decision which we need to take in financial management is investment related decision. Now what is investment? Investment means spending money. So in our accounts or in our basic classes, we have studied that there are two types of expenditure done by an organization. So one is the revenue expenditure, and another one we have is the capital expenditure. Revenue expenditure is an expenditure which is done for a given year. We have learned the definitions of revenue expenditure and capital expenditure. We usually used to say that revenue expenditure is an expenditure which is incurred for like less than 1 year, and capital expenditure is an expenditure which is incurred for more than 1 year, more than a year. But if I talk about the basic meaning of revenue expenditure and the capital expenditure, so revenue expenditure involves day-to-day expenditure, which needs to be the money which needs to be continuously expended for day-to-day needs of an organization. That is what the revenue expenditure means. Whereas capital expenditure is an expenditure which involves a little bit large expenditure than the revenue expenditure. So capital expenditure involves a huge expenditure, an expenditure which is done in a year, which is incurred at some point of time, and which can generate the benefits in subsequent years. So an expenditure which is incurred, which can generate benefits for like more than for coming years, it is known as the capital expenditure. Whereas if an expenditure is done and the benefit is obtained at the same point of time, then it is lost. That is revenue expenditure, which needs to be continuously undertaken to run the entity. But a capital expenditure once undertaken, it will survive, it will give the benefits to an entity for like 3 4, depending on the life of asset which is being employed. So under financial management, we'll be looking into where to spend money. That is what the investment decision is, that where the entity should spend its money. So capital expenditure involves an expenditure which is done for more than 1 year. right? So here under investment related decision we'll see like where to spend, in which capital asset the entity should spend its money, and how much revenue expenditure should be done. Okay, so in investment related decisions we'll be studying like where like how much money to be spent on long term related or assets, and how much money to be spent on the short term assets. Okay, so overall spending related decisions are taken in the investment decision. Then we have financing decision. So basically if you want to spend money, if you want to do an expenditure, you need to have some sort of money, then only you can incur expenditure. If you have some money in the hand, then only you can incur expenditure, otherwise you cannot incur the expenditure. So like where to get the money from, like what should be the sources, what could be the possible sources from where we can get the money, that is financing related decision. Okay, like what are the different sources? You have studied in your previous classes ki, that the business can obtain the money through equity share capital, by way of equity share capital, by way of preference share capital, by way of debt capital, okay, or by way of retained money. So business can get finance through different sources. Here in the financing related decisions we'll see like what are the different possible choices, what are the different choices from where we can raise the money, choices of raising the finance, what are the costs and the benefits associated with each source of finance, and which source of finance should be ultimately chosen by an entity.